Hey everyone. Today we're going to uncover some shocking truths about the Federal Reserve and demystify how interest rates really work in America. There are so many misconceptions when it comes to the Fed, monetary policy, and how rates impact all of us. I want to provide an illuminating deep dive into how the Fed operates, who is really in control, and what their decisions mean for your wallet and the economy. This is key info for making smarter financial moves no matter your income level or investments. Alright, grab your favorite beverage and let's get into it. The Fed is privately owned. Most people assume the Federal Reserve is a government agency looking out for public interest. However, the surprising truth is the Federal Reserve is actually a private entity comprised of 12 regional banks. These banks are owned by large commercial banks and private shareholders. This means major banking institutions like Citi, Chase and Wells Fargo have significant control over the Fed's leadership and policies. This creates an obvious conflict of interest between Wall Street and Main Street. We essentially have private banks controlling the U.S. money supply and interest rates. The Fed controls interest rates by directing fiscal policy and setting benchmark rates like the Fed funds rate. The Federal Reserve has enormous influence over interest rates across the entire economy. Rates impact mortgages, credit cards, savings accounts, business loans, and more. When the Fed raises or lowers rates, it gets passed on in the form of higher or lower interest rates for consumers and businesses. By controlling the cost of borrowing money, the Fed holds immense power over economic growth and contraction. With private banks governing the Fed, this means interest rates are set based on what most benefits Wall Street first and foremost, not average Americans. Low rates benefit wealthy investors. For over a decade, the Fed has kept interest rates extraordinarily low through quantitative easing programs. This was intended to stimulate the economy after the Great Recession by making borrowing inexpensive. However, these ultra-low rates disproportionately benefit wealthy investors versus lower middle-income households. The affluent hold most assets like stocks, bonds, real estate and can borrow huge sums cheaply. Working families rely more on savings accounts, CDs and fixed incomes which earn little interest when rates are low for so long. The Fed's monetary policies have dramatically increased inequality. Inflation eats away at savings. By printing trillions of dollars and keeping rates near zero for years, the Fed has triggered high inflation reaching 9–10% in 2022. This has led to skyrocketing prices that erode the purchasing power of everyday Americans. On the flip side, the wealthy own hard assets like real estate, art, stocks that appreciate along with inflation. Billionaires have added trillions to their net worths even amid high inflation. Their assets act as an inflation hedge. Working families see their monthly bills and grocery costs balloon while their stagnant wages and savings lose value. This is another way Fed policy harms the vulnerable. The Fed reacts slowly. The Fed is often behind the curve reacting to economic shifts, which leads to boom and bust cycles. With inflation surging, it took over a year for the Fed to start raising interest rates. This delayed response could have cooled inflation sooner and avoided the need for sudden, sharp hikes that may trigger a recession. The Fed has admitted they failed to act fast enough. Because of this sluggish reaction time, Americans dealt with drastically reduced spending power for over 12 months before rates finally started moving up. Quicker action is needed. Understanding the truth about the Federal Reserve, who's really in control and how interest rates are set is so important for your financial planning and for seeing the larger economic picture clearly. The Fed's policies may aim for optimal employment and stable prices, but they disproportionately benefit the billionaire class over working Americans. This context helps us make better financial moves and advocate for reforms that rein in the unchecked power of the Fed over our economy and money supply. I hope you found this breakdown enlightening. Make sure to subscribe for future videos exploring controversial economic topics. Leave your video requests in the comments. Thanks for watching.